Hi everyone, my name is Phil Compton. I'm the co-founder and CFO of a local cybersecurity company called Malcovery Security. We are in the process of selling our company, so actually we're supposed to close on that transaction tomorrow or Friday. So on my way over, I was fielding calls from lawyers, CEOs, salespeople, auditors, accountants, getting customer consents to assign our current contracts to our acquired company. Could not find a parking space. I ran here, so here I am. So everything's under control now. So it's only going to get easier from here. So this is financial modeling. This is the third time I've presented this class, and hopefully you'll get some good tips out of it. So a little bit of information about me. I went to WVU, a little bit south of here. Some of you aren't from here, I understand that, but it's about an hour south of Pittsburgh. I am a CPA, but I've mostly been an entrepreneur, a small investor, and an advisor to local Pittsburgh area technology companies. I've got 3 decades of experience, so I've been around the block a few times. Started out with one of what's called the Big Four public accounting firms. It's now called PwC, PricewaterhouseCoopers. Started out as Coopers and Lybrand for me. I then went to a big local public company, Black Box. It's the quietest billion-dollar company in Pittsburgh. You don't hear about it much. They're very insular and aren't real active in the local community, which I've always thought was a shame. But they're listed as B-Box on NASDAQ right now, so you could look them up. Mallet Technology was a reseller for another billion-dollar company in Pittsburgh called Ansys. Started out as Swanson Analysis Systems, Inc., or SASE. They had a product called Ansys in the beginning. They liked the name Ansys so much, they renamed the company the name of the product. So now it's called Ansys. Great company if you haven't heard of them. I then went on to a very small company, a CMU startup. So right out of CMU here. This was an internet search refinement tool, kind of a precursor to Google. This was actually purchased. I helped conduct the purchase of this company by Lycos, which is another CMU startup and spin-out. Lycos was a big deal in the late 90s, early 2000s. They ain't anymore. So a lot of the tech era internet-based companies are either shadows of their former selves, or they're just not around at all. Lycos still does exist, at least. What's funny about WiseWire is this was actually founded by a CMU student, grad student named Ken Lang. He joined up with another fellow CMU-er named Rob Frasca. They had a professor named Mike Malden, Fuzzy Malden, who taught in the computer science department here a long time ago. And a funny irony, Professor Malden bought his student's company, WiseWire. So Lycos bought WiseWire. I've always thought that was so funny that a professor with students here would end up, be involved in a purchase transaction like 5 years later, completely out of school and everything. That's just so funny. I've been involved in a lot of venture capital funding, raised $60 million at one company called CoManage. I've raised about $100 million altogether, $5 million for the company that we're just selling, like I say, in 24 or 48 hours. A lot of other financial transactions. What I really like to call myself is a revenue enhancer. So I'm not just a bean counting finance person. I actually love to get out, talk with customers, and help close deals. It's not near as exciting to me to count the beans if you're not bringing in the top line, and that's revenues. So companies are all about bringing in cash, hopefully customer cash, not investor cash. Investor cash is dilutive. We'll talk about that. And I've been involved in board level stuff, in fact, just 10 minutes ago. I was named Pittsburgh Business Times CFO of the Year last year for small companies, so got a little recognition for that, and very active in the local tech community. Like I said, we founded this company, we founded it about mid-2012. We didn't really start operations till January of 2013. And we're just being acquired. I mean, literally, that's fresh red ink. We licensed technology from another university that's renowned for cybersecurity, because CMU certainly is. University of Alabama at Birmingham. Sounds kind of bizarre, but I, through connections, got connected there, and we're now, like I say, selling that company. What we did do, is we have patented solutions that help a company protect their network, their IT infrastructure, or their brand name in the marketplace. For example, Visa is a customer of ours. The more their name is phished or spoofed or spammed in the marketplace with you as customers or potential customers, the more uneasy you feel about their name. So that's their brand. So we help protect that brand as well as protect their IT infrastructure that you're more used to, the physical network. We went from keystroking the business plan. I heard someone talking about a startup here. I was a little bit sidelined there. We went from typing our business plan to closing 10 Fortune 500s in our first 12 months. Good stuff. Not normal. We probably had a little bit of luck, a lot of blood, sweat, tears, negotiating, sleepless nights, and that's a heck of a track record. We've closed 15 altogether in our 3 years, so we really had a bang-up first year. So enough about me. Why don't we go about looking at our agenda for the class here. And that is, we're going to look at how you plan and the assumptions you make and how you document and build your financial model, because you'll certainly need that if you're going out for funding. How to test it, how to stress test it and sensitivity test it so that someone else doesn't find glitches or mistakes in the model. That's not a good thing to have happen. And while this isn't 100% related to the subject, it's always germane to every aspiring entrepreneur's process, and that is demystifying the cap table. So I'm going to make it easy breezy for you. So we'll cover that in the third section. I'm going to go in about 20-minute increments. I know that it gets a little bit boring and tedious at times, so I'll break for questions every 20 minutes. A planning horizon for your model, typically what an investor wants to see or what you should think about when you're founding a company is the first 3 to 4 years of existence. Let's be honest, starting your company, you may not know a whole lot more than that month that you're in, the next 30 days. But as you know from probably writing business plans, I'm just going to assume that you've been involved in that in some fashion. I don't know that for sure. You have to look at more than just the current day. No one's going to get too jazzed about the company if you just say, here's what we think we're going to do, and don't really have any plans to get there, but how would you like to invest some cash? So you've got to lay out a time frame, and 3 to 4 years is the typical time frame you should have financials in your business plan. The first 2 years should be monthly, painful. That's a lot of detail. Quite frankly, you'll probably only really be critiqued or judged much on your first 12 months, because 12 months from today, put a stakeholder here, look at 12 months from now, a lot of things are going to be different, and investors know that. What are you planning towards? An initial funding round, which would probably be relevant to what most everyone in this room would be thinking about. Or are you actually going for follow-on funding, perhaps even an eventual liquidity event? We'll get into some, well, let's go to that. So an eventual liquidity event could be an acquisition. That's probably easily, I'd say, 2/3 of what everyone's goal is. Build up a good company, obtain customers, get to some level of profitability, get to cash flow neutral operations or even cash flow positive operations, and eventually sell that company to someone else who's interested, much like we've just done. Or, but I would caution that that's a little bit of a short-term focus. You know, this isn't like a reality TV show where you're going to flip that house. I don't know that I'd start out a company thinking I'm going to flip this company. Could happen, has happened. There's a lot of examples in the tech world where that has happened in a year and a half, 2 years. That's not the norm, and I would caution against that approach. Also, building a company to become public. That used to be real, like considered a badge of success in the 90s into 2000. Everyone wanted to get to the public market, cash in at this crazily overvalued tech market, and then you'd be investing yourself. You'd be funding companies. That somewhat died with the great market downturn. The tech bubble burst in 2001. It even further was damaged in the Great Recession starting in 2009. It still happens. I mean, obviously, a lot of companies go public, but to start out a company with that being at least a near-term goal, I'd caution against that. Could be an eventual goal. My suggestion would be maybe the other third. I said there's 2/3. Here's the other third: is build a good company for the long term and see what happens. If you're knocking down those customers, obtaining those customer logos, as I refer to sometimes, churning out cool products and services, getting to cash flow positive, good things are going to happen. And maybe you just kind of wait and see what happens after you've built a winner of a company. That's not a bad tactic. But be realistic in your numbers and the time it takes to achieve them. To project that you're going to close those 10 Fortune 500s in the first year, we didn't project that. So we were happy to achieve it, but we didn't expect it. To go out and forecast $2 or $3 million of revenue in your first year, now you may have specific circumstances to where that could be possible. That's not the norm either. It might be a few hundred K, maybe up to $1 million. It might not even be any revenues your first year. You might just be developing a product or your business model for the next 6 to 12 months, and customer acquisition really isn't in the cards until quarters 3, 4, 5 out there. You'll be viewed as credible and trustworthy if you're practical, as opposed to, here's a bunch of numbers, throw the dart up against the board, and I haven't really checked them out, vetted them against anything, but that's what we're going with. Gonna be ballsy and bold about it. So you'd want to be a little bit conservative here. I just happened to build a model that you can use. So I think Allison probably notified you that there's 2 models, 2 Excel files out on whatever site you have. And that is a financial projections model and the cap table that we're going to go over. So we will hit those. Let's look at some more assumptions. In that model, if you happen to look at it, which probably did not, and I don't blame you, we're going to see it in a couple slides here. I always suggest to keep a notes tab or an assumptions tab. And that is because as this fellow here is writing notes, you could write notes about your assumptions. You could just remember them in your head, and what you will do under pressure is you won't remember what the heck you did. And your partner won't remember what you did. And your future controller won't remember what you did. And your investors won't know what you did. So keep a running tab, a notes tab. Just document all the points. You could just go throw up bullet points as you're going and then make it a nice, prettier read when you're done. But it'll show the audience that you thoughtfully went through your assumptions, what they are in the first place, and it just gives more comfort to what you've created. Know that everything affects your cash. I'm going to pound the table on cash today, so you'll hear me focus on that a lot. In your assumptions, what type of company are you going to create? You're going to produce medical device, build apps, software company, hardware company, a consulting business. There's nothing wrong with being a consulting business. It's generally a lower growth trajectory than a product company might be, and it doesn't suggest that consulting is a lifestyle business. You might have heard that term before. A consulting practice or business can be just fine. It's probably actually easier than building, well, it is easier than building a product company almost always, as opposed to building a silicon chip, which is something I was involved with at a company called Netronome. That's complicated. So a service can be a lot easier. Maybe you can get that company up and off the ground easier just being a consulting company. That's going to be a different cost structure, different employee structure between those 2 types of companies. Are you going to build it or buy it? So you can manufacture a product. You might want to manufacture the latest and greatest pointer. Or you might want to actually represent a whole horde of manufacturers and just be a reseller and then build consulting practices around all the products that you represent or sell or tote in your bag. So actually, software development is manufacturing. It's just a virtual version of manufacturing. The code is your inventory. So if you've kind of struggled between a product company and a service company, there's actually a lot of parallels because software development is a manufacturing process. Are you going to try to generate your revenues through direct sales team or partners? And I've got a strong opinion here, and that is I think at least for your first year or so, you ought to be direct sales. I call it hand-to-hand combat or guerrilla warfare. So we didn't close those 10 Fortune 500s through some disassociated partners. We did it with our own, like I say, blood, sweat, and tears. In that process, you learn about how to sell the product in a repeatable, standard, predictable mode. You also become an evangelist about the product or service that you're going to try to get partners to then represent you for. So a lot of small companies will always want to rush to have partner logos on their website. Oh, we've got all these partners on our website. A lot of times when you look at early stage companies' websites and you look up partners, they have other early stage companies, and I call that 0 plus 0 equals 0. There's no glory to having 3 Oakland-based startups all on your partner page because you're all figuring out and kind of groping along. Wait until you've got something worthwhile to list on there. And like I say, you're going to learn a lot more by doing it yourself, and partners, quite frankly, won't be real interested if you haven't shown sales traction yourself. You mean you've never sold any of this and you want us to go out and sell it to you or for you? Good luck on that. How many employees are you going to need to build your company? And we're going to see that people are very expensive, so a big factor. Here's a snippet of that notes tab, and I'm not going to go through much detail here. Sorry if I'm blocking people. A couple of things I just might point out here is for salaries, and by the way, you might list your expenses in order of how they might appear in your P&L or your income statement. We'll go over that. But salaries, what percentage of a company's expense structure would you guess or maybe know that employee cost or people cost usually comprise? Yes?
Depends if it's hardware or software.
Yes, because software would be more people intensive, manufacturing like I talked about.
For software, probably more 80, 85%.
Yeah, it's probably 70, 72, maybe 75%. If you pay people more, it'll be higher. If you're in cheap office space, it'll be higher because you're spending more on people and less on the space. So I don't discount your range, what you said. But that's going to usually require a separate tab, and I'll show you that tab because it's such a huge part of your expense structure. Another example might be marketing, events and shows. Be very careful about trying to go to trade shows and events. You can blow your entire budget just on traveling around to industry shows. It sounds like it's really a relevant thing to do. I would say that a lot of business used to be generated through shows. Everything is so virtual and mobile and spread out now. I don't think that people wait until there's a huge show in Atlanta to attend every year. They're doing that virtually all year long. So I think the thought of that being, excuse me, probably someone want to talk about the sale. I think that the days of that being a big ticket item are gone. So it's good to have, again, that notes tab that I talked about. Lets people know what the assumptions you made. In those assumptions, what tools do your employees need to do their job? Well, I've worked with a lot of technology companies, and one thing I've come to know is techies love toys. So software, I'll just say software developers. Let's just use that as an example. Software developers love the latest and greatest laptop, 2 big honking monitors, a nice Aeron, $1,500 Aeron chair that adjusts every which way but loose, a stand-up desk, that's a big thing now. Maybe I actually even want a, help me out, a walking desk. Treadmill desk, yes, sorry. And I even want one that I push a button and it goes up and down. I don't have to manually crank it. That's such a pain. Your answer to most of these requests are going to be the word no, N-O. Where are you going to put them? How long are you going to stay? Space is one of the biggest mistakes that early stage companies make. Do you want to portray to employees and potential customers that you've made it by signing a lease immediately on the third floor of PPG Place 6? There's actually a startup in town that did that. I better stop talking right there. But one of the companies did that. Or would you rather do like Dick Zhang did at Identified Technologies, go to an old beat-up warehouse in East Liberty, no AC, dirty floor, dirt everywhere, and just start camp right there? And he actually lives over top of the office. Yeah.
So I had a friend who started a company, but it was a consulting firm.
Yeah.
And he was in like downtown Manhattan because he felt that it was easier for him to get customers that way. But I guess if you're developing a product, it's different. But like you're more customer facing and you're doing consulting, sometimes it is better to be at like a PPG place because you get a lot of push.
Yeah, Madison Avenue, wherever he was in New York, would certainly be, that would be starting out kind of at the top, yeah. So the problem with that is, and I'm not discounting it could be advisable in some situations. The problem with a lease is it's a commitment. And the problem with a commitment means it needs to be paid no matter what happens. So let's just say, and this is a real life example, you want to take space in, I don't know, they're building a lot of new buildings around here in Oakland and CMU area. So you want to take space on the third floor of a nice new building and love to look out over the campus, and you know, it's going to be a nice, your logic is that's a nice recruiting tool for employees. And that part I can't knock you too much for, because recruiting employees and exciting them to join your company is very important. But some negative sides to that is they might want a 3-year lease. They're just simply not going to do anything but a 3-year lease. And as part of that, because you're a brand new company, they want a guarantee on the lease. In fact, they want a guarantee from you. So you're going to put all your cash up, all your investments, your house, whatever you might have, your car, and you're going to guarantee that lease. Company goes belly up in 10 months. Just didn't work out. Crap happened. So 10 months, company's underwater, you are paying that lease for the next 2 years and 2 months. You could maybe negotiate a settlement, maybe go through $8,000 to $10,000 in legal fees to negotiate a settlement, but your name is guarantor on the lease. So I'm a cautious person. I would just caution you to tread very carefully on space in the beginning. A company can be just as successfully started in a dorm room, Dell, or a garage, or a basement, or meeting at Starbucks, meeting at Panera, or just actually living where you live and do everything by Skype and mobile and using Grasshopper as your office phone, so you have an 800 number, so you appear bigger than you are. And you can actually get a company started pretty cheaply in the physical environment sense. Again, marketing efforts, you can blow a lot of money here. I don't know how many companies in the older days where we had boxes and boxes of collateral and handouts and all this stuff that probably 70% of it always gets thrown away. Another big expense consideration is how much will your sales team travel? Hopefully not much. And in this day and age with WebEx, GoToMeeting, and all the other acceptable ways of making presentations, you shouldn't have to travel that much. There could be times when you do. Peacemaker Technologies has a 3D printing business. They probably need to go on site to Toys R Us, which I think they did here in Pittsburgh and in New York, and demonstrate what that printer can do, the little plastic toys that it can, and figures that it can print. I say Identified Technologies again probably has to take their drones out to construction sites and show their prospective customers what they can do. But if you're developing apps and software and stuff, you don't really need to go visit the customer that much. And that's good because travel is expensive. So all these assumptions are big ticket costs that are going to eat up your cash, which we don't like. And you are going to learn the word, those magical two letters together called no. That you're going to be unpopular at times with your initial team and your employees, but you're going to learn how to say no. In fact, speaking of cash, here we go. Cash is not only king. That's what a lot of people say. I say cash is King Kong as I hit the desk. So you will remember that, and that's the most important currency you have, no pun intended, is cash. Cash and people. All right, I'll drill that in some more if that didn't work. Almost at our break. Keep the model understandable and easy to update, because you don't want a model that's built so elaborately and it's all impressive and you're the only one that understands it, because that means you're the only one that can update it, which means you can never be free of that chore. It also isn't fun to spend 24 hours updating a model every time you have to update it, because you might have to update it 4 times a month. So don't make it so elaborate and so impressive that you end up paying for that. And again, build it in a modular sense, in that what happens if you add a body, what happens if you offer more benefits, what happens if you purchase those 2 big honking monitors. I was in a startup one time where cash in that time of, in the tech bubble days, was actually not that big of a deal. And I was actually told by a VC whose name you would know from around town, that's why I'm not going to say it, that don't worry where that came from, Phil. There's plenty more where it came from. So we've got a lot of dry powder for you guys, which means we've got follow-on investment money that we've allotted in our funding, that if you need another 10%, 20%, 30% funding, we've got that reserved for you. The tune has changed quite a bit. So now you're expected to be capital efficient. It used to be, again, a badge of success. How much money could you raise? Well, I tell you what, I was involved and I helped lead Pittsburgh's largest VC funding round as of September 2000. I know that's ancient. It was $39 million. That's still a big round today, and that was a record for Pittsburgh of all time. It's probably about number 15 now, but anyway, it was a lot of money. We could have taken on $50 million. VCs were throwing money at us. We don't even need to see what you're talking about here. We know Goldman Sachs came in, Adams Capital is in, Birchmere Ventures is in, Columbia Capital is in, Lucent Ventures is in, SAIC Ventures is in. We want in. We don't even need to see anything. Just give me a document I can sign and your wiring instructions. So it was crazy. Looking back now, I wouldn't mind a little bit of that right now. It's nice in moderation. You don't need to take on a lot more money than you need. But anyway, cash used to be not that important, even in the investor's eyes, which was mind-boggling. That was fantasy land to some degree, fun as it was. So we're going to be concerned about any of these items that take cash. I know I got off on a tangent there. So let's look at just another snippet of the model. This is one of the tabs. It's called the Employee EMP, INT, I think, INP, Employee Input tab. And again, this is going to be about 70% of your costs. So let's say you start a company with 3 people. One of you is the big cheese. One of you is the chief idea guy, and the other guy is going to build the product. And you've probably got all the other kinds of goofy names coming up there. This was actually our 3rd year of operations. Our first year, want to know what our comp was? That. A perfectly round circle, 0. Nothing. So for the first year, we worked for nothing. For the next 2 years, we worked for 60% of market value. So I never did make my market value there. But that's a lot of the investment that you make of yourself when you're building a company. In our case, we ended up selling the company. And investors appreciate when you're not going out and trying to give everyone 6-figure salaries from the very beginning. Although graduated with a graduate degree from CMU, many of you could garner something in that range or perhaps more. But again, that was not year one. You fill in your amounts, you fill in your timing. The model that I've built extrapolates all the calculations to the right. That flows into the departmental expenses of G&A or software development or sales or product management, which flows into operating expenses, which flows into the P&L, which also affects the balance sheet and the cash flow. So that model is built to where if you just input in these green and blue cells, it extrapolates or automatically calculates the results. So I think that'll be real helpful for you. But again, 70% of your expenses tab, important tab. And you'll be changing these figures all the time. I don't think I've ever seen any company that hires as fast as they plan on. And it's amazing how many companies plan to hire almost everyone January 1st. It's like January 1st is a magical date. We're going to hire 20 people next year, and 18 are going to be on January 1st. No, they're not. For some reason, that's in people's mindset. Spread them out, feather them out, and don't hire until you need to. Because again, believe it or not, this is a legal obligation. Even though Pennsylvania, and you're not just going to have your company in Pennsylvania, I know that, but in most states, they are what's called an employer state. So you can terminate an employee at any time for any non-discriminatory reason, but usually there are some roots to their employment. They could file for unemployment affecting the amount of unemployment tax you pay. They could sue for wrongful termination or discriminatory testing. That could involve headaches. Generally, you might be paying some kind of severance to get them to sign a separation agreement. So it's not just, I hired this dude on March 1st, I canned him in September, end of story. Nah, there's going to be some residual amounts. Plus, employees are just a lot to manage. One of those VCs that told me there was more dry powder, he came in my office one day and he goes, okay, so you've raised this big amount of money, guess what your next problem's going to be? And we're just like, oh my God, it's going to be, building out the product to meet AT&T Wireless's specs as they want, and building out the product more and differently so that Sprint long distance division will purchase it, because we've talked to them about it. He's like, no, it's going to be managing all the damn people that you're hiring, because managing people is a pain in the ass. And it is. Not trying to be jaded, I'm just saying every person is different, and it's just as normal to have a challenging experience with an employee as it is to have a pleasant experience with an employee. And you're talking to the guy who's been HR for most of my companies. I've seen people cry, yell, scream, pound on the desk, a lot harder than that, come across the table after me, call their spouse in to double team me. So I've had a wife or a husband actually come to my office, crying is always a good one. So, but I've had a lot of people thank me how I've handled that. So, because usually I try to just calm everyone down. You can see I'm selling a company. I don't look stressed now, so I try to be calm. I am a little bit stressed, I admit. People are a big item to handle, so it's not to be taken lightly. Here's just a little example of maybe a ramp that you might want to show. We had a certain amount of people at the end of 2014. That would have been a good column to have here. Here's the number of full-time equivalents we plan to have at every end of quarter, so we're going to add in this year 11 people. By the way, as I said, be slow to hire. Bring people on part-time or as contractors. Contractors means that there is somewhat of an arm's length transaction or relationship between you and that contractor. They're not a recognized employee. They're not an IRS recognized employee if they don't get a Form W-2 at the end of the year. Rather, they get what's called a Form 1099, which means you're a contractor, which means you're a consultant is what you are. So there's not as many tentacles to a relationship if you just do the contractual situation. And in a lot of companies I've helped to found and grow, we've gone with the contractor status for almost everyone. And that also allows you a period to see how you get along. If you're only dating, it's not as painful to break up. If you're married, it's harder to get a divorce. So think of that as a parallel. Go with contractors if you can. Usually a little bit cheaper too. and you'll learn about who you're hiring. So again, just to repeat, build a model so that you know what happens if you add any of that stuff, blah, blah, blah. Okay, so what are the three financial statements?
Balance sheet, income statement, cash flow.
Cash flow. Do you know that there's actually a fourth financial statement? I don't even list it here. It's the statement of stockholders' equity. That's right. So it's one that you do find in SEC filings. It's not one that anyone talks about. It's just kind of, it's a mini version of a cap table. It shows what happens with your equity section over time. Wow, this is busy, isn't it? So these are your your three financial statements I talked about. Income statement, what you sell, how much it costs you to produce what you're selling, what it costs to operate the company, what you earn or retain, or earn or lose at the bottom. Balance sheet, what you own, assets, minus what you owe, liabilities, equals what you keep or retain, equity. And the cash flow is a measure of that ever important cash that I've been talking about. They actually are intertwined, and it always kind of struck me as odd why in any of my accounting classes they never kind of spoke to it quite like this. So I decided to just kind of make this up, and that is the income statement, what you earn, actually reconciles to what you earn in the balance sheet. So those current year earnings equals what's retained in the equity section of your balance sheet. It's also the only figure that's used in all three financial statements. It's also the beginning of your cash flow statement. It converts accrual-based profit and loss or income statement into a cash statement. The result of that cash also bounces and becomes the cash on your balance sheet. And of course, assets and liabilities and equities have to balance. So I thought it would be good to just see this little demystifying chart and to reconcile all those. Here's another little blurb, I think, from one of my backup slides I moved up here. Revenues are going to be the hardest item or line item for you to project. It's not hard to project what rent will be if you've got no rent, which is Phil's wish, or you've got a lease that has, here's what your rent is per month. It's not hard to know what someone's salary is if they're making 50 grand. It's 50,000 divided by 12 every month. It's not hard to know what the taxes will be if FICA and Medicare are 7.65% and your state percent is a certain percent. So a lot of the expenses actually are known. You can always hire or incur expenses out of your plan, but you generally know what they're going to be. Revenues are a crapshoot, I'll be real honest. If you're starting a company and have no line or lead on any customers, you are going to be doing a lot of guessing. You're going to be making educated guessing, so you're making guesstimates, but it's going to be a lot of guessing. If you're starting a company that we were fortunate enough to and actually had named prospects who we'd talked to before we formed the company, that's kind of I call it an elevated startup. You've already pre-baked in at least some of your pre-sales activity. So we actually started a company and had like 10 prospective customers that we were talking with that we could show investors. We have some level of interest, some a lot, some not very much, with these 10 or so companies. And they're like, whoa, okay, you're ahead of the normal game. You know, you're not your typical startup. But if you haven't done that, you're starting out with the widgets picture. And that is, you might look and see through your research how big your market is, which, by the way, in retrospect, $100 million isn't that big of a market, but let's just assume that. Nice, easy math here. Your market is $100 million. You could look at it two ways. I want to penetrate 0.5% my first year. Just feels doable. I want to get, ramp in that fashion, so I'll actually be, 8 times as much in 5 years. So if I want to penetrate $100 million, 0.5%, that's $500,000. That's pretty easy math. I've researched, and I think I can sell my product or my service for about $10,000 a piece or per engagement, so I have to sell 50 of those customers or 50 projects or whatever it is. And that way you could get to your number of units you have to sell. Or you could say, here's the market size. I think I can do $500,000. Here's my average selling price, so I need to sell 50 of these things. So you can get it, bottoms down or tops down or bottom up in terms of doing your revenue. But revenue will be your hardest, tab or line item to build. So the product is, if you build your model in this modular fashion and go along the lines of the model that I've supplied, or maybe use someone else's model or build your own model. You'll know more about the model if you build it, I'll tell you that. You'll know every keystroke. But if you can stand on the shoulders of someone who's done it for you, don't be hesitated to copycat some. So let's keep going here. We'll talk about use of a toggle cell. I'll get to that in a second. But I did want to stop so I don't put anyone to sleep and just ask if there's questions thus far. We're about close to halfway through. Yes?
I don't want to digress too much, but
Yeah.
you mentioned about commercial space. Now, I was just wondering if you had any tips for trying to find something. I'm not talking about anything fancy, but it just seems like if I want to buy a house, I get a real estate agent and they help me, It seems like I'm just forever just trying to call people and, they don't put the prices out there and you go look at it and it just seems so tedious to try to find something.
Well,
I don't know if you have any advice.
Yeah.
If that's just the way it is.
Sorry. I don't know where I read it. It was either the Pittsburgh Business Times or the Post-Gazette. I'm forgetting right now, but it actually was an article about all the low-cost, flexible, short-term space that is available in the greater Pittsburgh area. And they talked a lot about Oakland, East Liberty, over by Bakery Square. They talked about the new Nova place over on the north side. They talked about sea-leveled. I think it's Pittsburgh Business Times the last week or two.
Okay.
But there is, you have, in this market right here, this is a crowded spot right here. So around any university, it's always going to be space as a premium. That's the same in almost any university city, not just Pittsburgh, not just CMU's campus. So you may have to go it a little bit further. As I said, this company called Identified Technologies found an old building that was very sturdy, but was a manufacturing place, and now they basically run their, not only development, but also their, general operations out of that building. So you can find sweetheart deals or relatively inexpensive deals. Another place to look is when we raised that $39 million, we went out and blew a bunch of money on hiring all these employees. And we built up all this space, and then we went through a couple of reductions in force, so we had about space for 100 people available. We ended up actually partitioning it out, and I became an unplanned sub-landlord. So I sold pods, I called them, about this big, and a company would start basically in a 20 by 20 room, and they lived there for the first 1 to 2 years. So you can find those sweetheart deals, and you can put up cubes in here, and you can put 2 to a desk. You could probably, in this space right here, you could probably, with noise canceling headsets, and you could probably put, 12, 14, 15 people in here. So look for subleases. Go out and just Google it. That might be a good way. Anything else?
How much detail do you suggest going into on the expenses like overhead for employees? Is it better to just use an approximate 15% overhead, or should that all be broken down into this much as workers' comp, this much as unemployment, this much as and so forth?
I think you should break it down somewhat, and that is, it's well known what employment or payroll-related taxes are. So there's federal, state, sometimes there's local too. So that tax, since it's very well known, why not identify it? You could go on a certain amount of health care insurance for a single or a family per month and just use that as a factor. So in other words, if it's $300 a month for a single person divided by the average salary in the company, that that figure, let's say it's, I'm not going to do math on the fly, it's 0.2%, just plug that in the employee insurance line. You might also have a certain amount of training. Maybe you want to send people to training. That's probably not year one focus, but that might be in there. So I think you could probably do the taxes as pretty exact, health insurance as a percent, and then maybe just another 1 or 2% for everything else. But at least stratify it somewhat like that, instead of just saying it sounds like, 15-ish%. By the way, it'll probably be around 15%. 15 to 18%. Okay, let's move on. We're now going to look at, this is the testing the model section. It's going to be kind of a hybrid of testing and some key terms. Burn rate, you've probably heard that, or you've probably seen that in some of your classes. I'm burning this much per month. Well, that doesn't mean you're going to a bonfire, but although I am from West Virginia, so I might be. The trending amount of cash you consume in a month is the cost to produce your product, or maybe it's the cost to produce your service. In our company, it was the cost of service, not cost of goods sold, but the cost to produce your product or service, plus all departmental or operating expenses, plus capital expenditures. So if people, again, want those big honking monitors, I keep coming back to that, or the treadmill desk, that's all going to cost money. That's usually a capitalized or fixed asset or property, plant, and equipment item that has to be given a useful depreciation life and depreciated over a certain time frame. The cost of those sporadic purchases needs to be part of your burn. And also debt obligations. And you're thinking, debt? Yes, debt. If you start off a company and take on notes or notes that are convertible into equity, that's a model that Innovation Works would undertake, for example, or maybe Idea Foundry, which is real close to campus here. Chances are you don't have to repay that debt in cash over time. It'll probably be convertible into equity when you do raise your first real outside round of funding. But if you're lucky enough to take on debt where you can actually have the option to repay and you do well, you want to repay it because then it's non-dilutive. Maybe you actually took out a loan from family and friends, mom and dad, the rich uncle, or a neighbor that just happens to believe in you. You borrowed 20 grand and you actually will pay it back over time. So these 4 items all go into what's called your burn rate. You could say it in terms of month, quarter, whatever. That's how much I'm burning per month. Okay, well, what's your runway? It's the amount of cash you currently have on hand divided by that burn rate. So let's say you have $1 million in cash, nice big fat round number to start off with, and your average burn rate for the first year is $100,000. I'll do easy math. You've only got 10 months of cash. That's not very long. If your average burn rate is $50,000, you've actually got 20 months of cash. 1 million divided by 20, or 50,000, excuse me. A point on this subject, and that is anytime you reach the point where you think you've got under a year's worth of cash on hand, which is probably going to be every day for your first couple of years, you're going to be under stress the whole time, it's time to start thinking about raising funding. I know this isn't as relevant to a brand new startup because you're starting, but anytime you think you're within maybe 10 months, 10 to 12 months of needing cash, start the process because fundraising is painful, takes a long time, very time-intensive effort, and you don't want to be raising funding when you're just running out of cash. You then are on Shark Tank because you have very little options and you've got the sharks circling around you, and they're like, oh, you know what? I could invest $300,000, or I can just wait 60 days because then you won't have any cash, and I'll get 50% of the company instead of the 33 that you were asking for. So I'm good. I'll just kind of hang out here and wait. So that's why you want to start earlier. EBITDA break even. What is EBITDA? What does EBITDA stand for? We have an accountant over here, okay? So it's earnings, and the reason it's important is because it's figured or assumed that earnings before interest, tax, depreciation, amortization, that's what it costs to really run the company. It's not part of the ongoing operations that you're an interest-paying company. That's kind of an after the fact. It's not part of your ongoing operations that a certain state has a certain tax. It's just a fact of life. It's not an ongoing expense that computer, the two big honking monitors, excuse me, that you purchased are depreciating over 5 years. So really we look at what's called income or loss from operations, or EBITDA, to judge you on how your operations are doing. Yes?
So when should you start fundraising? I know you said it takes about 12 months. Should you wait until you start making, a certain amount or acquire a certain amount of clients and then start fundraising?
If you can wait for what you just said right there, that would be great. Unfortunately, a lot of people can't afford to take, and let's assume you have no other money. You'd basically be, you or your staff would be working for nothing. So they might be working for the equity that you awarded them upon starting the company, but chances are you're going to limit the amount of people you can attract that don't need any cash.
But the investors are going to want to see some type of cash or sales or growth.
And I don't want to mislead. First of all, 12 months is a nice, comfortable thing for me to say. The other side of that, and I'll kind of contradict myself, is the longer you can wait and produce some more results that gives you some momentum that if you haven't closed any customers, at least you're talking to 3 really high probability ones that are just waiting for a certain improvement or release of a product, and they'll purchase.
And those 3 are on the enterprise level, not on the B2C, right? Because if you're B2C, you want to have more than 3 customers.
Oh yeah. So that would be in B2B. Yeah, we'd be talking about corporate customers, not some dude on the corner that's looking for your next app that's going to cost him 99 cents on iTunes. Yeah. So it's going to be bigger than that. But the more momentum you can show, and the more customer traction, even if near term, that you can show before you fundraise, sure, that'd be great. A lot of companies kind of have to have some amount of cash to start, because you're also then not able to pay that lawyer that's probably giving you some advice. You're also probably not able to pay that landlord or your parents or whatever wherever you're located. You're also maybe not able to pay for cell phones for people or whatever. So we were able to delay our funding because we could cover all that. But the younger you are, the less likely that's possible. But that'd be good. Okay, so investors look at EBITDA. When are you EBITDA break even? In other words, when are you profitable? Forget all this extraneous junk. When are you profitable from ongoing operations? That's their concern. Same with cash flow break even, cash flow. The point at which net cash flow is achieved on it, and when I say a sustainable basis, it's more than just 1 month. You might actually be profitable and non-profitable, profitable, non-profitable, and on a roller coaster ride. In fact, most likely you will be on somewhat of a roller coaster ride, so hold on. But it's usually for 3 months I'd consider sustained. A lot of companies are cash flow negative every month in a while, every once in a while. So it's not like you never are allowed to go negative. But when you've proven that for 3 to 4 months that you're break even on either measure, you're then considered break even. Be assured you will almost always burn cash before you sell. There are exceptions, but you'll almost always, again, have to expend before you collect. Want to have a question? Okay. Yes.
What is the typical range that you see in terms of break even? Like how long? Approximately 2 to 3, 4 years? Is it really determined?
I hate to say it's a matter of math, and that is if you can close a couple of customers and actually get them to pay, because you might actually have non-paying customers. That would suck, but they might give you advice and help you to iteratively design your product with all the feedback and the pain that they go through working with your beta and your alpha and everything, so that they're not going to be cash paying customers, but they are still value added. With that, value added doesn't make the rent or it doesn't pay the payroll. So it's really a matter of your math, and I hate to say I can't give you an absolutely typical time frame. In the older days, in the internet, in the tech bubble days, there don't worry about break even. It's not a big deal. There's always more where that came from. So really, profitability and cash flow break even was somehow in the whole history of profitability being a goal, it was just forgotten from like 95 through 2001. It was a black period in time where who gives a crap about profitability? Just build it and we can sell it. You would hope that you're not going out for funding every year. First of all, it's hard as heck on you. Secondly, it's going to look like you aren't very good at planning because you're coming back every Q1, you're coming back for another round of funding. It kind of leads to investor fatigue, or maybe undermines their confidence. So I would hope as a goal for any company I would be involved with to be cash flow break even by around the end of the second year. I'm throwing that out there because I think 2 years is a long period of time from which to live from your initial funding, and people would give you those 2 years to get there. All right, what do we got next? Oh, little income statement here. So this is a projection. Again, these are mocked up. This isn't real. This is a projection of 2015. Revenues are ramping up. You can see there's a nice quarterly run rate there. The cost of service leads to a gross margin that's improving from about 50% up through about, the more typical software company is going to be in the high 60s to about 70%. So I'd say that's a typical software company pumping out margins of about 65%. Operating expenses, you'll have some people here, most of your people are going to be here. Costs a lot of money to obtain customers, doesn't it? As your customers grow, the cost to obtain them, all your sales costs, all your operating costs increase. Here's this EBITDA. In this particular year, while things were improving, it still wasn't a huge improvement, and it wasn't to break even in that year. That's this particular year. Here's the burn rate. Again, it was cost of service plus operating expenses plus capital expenditures plus debt obligations if you have any. Always good to keep track of your head count. Remember, I suggest that you have a certain amount of contractors in there. Let's keep going. So you won't build a perfect model the first time and maybe not even the second or third time, but the point is you want to build something that, again, is easy to update. So I know I'm kind of repeating myself here. One thing I would say is don't let someone else, investors or whoever, find the mistakes that are in your model. If you use my model, hopefully there won't be any. But as you tweak it or build your own model or whatever, you're gonna probably have a couple of ghosts in the machine there that aren't apparent to you when you've gone through and built the model. It's much like when you let's say you write a white paper, you write an article. You always want someone to proofread it. That's standard quo in the publishing industry. You also want a fellow team member to go through and kind of play with your model. Or you take a break, come back and play with the model. What happens if I do this? It's like, whoa, how did revenues go negative? Revenues have never been negative in any company in history, so I think my model is screwed up. So you want to be sure to go through and stress test it before you give it to someone else. So does it behave in the way and respond in the way that you had envisioned? If not, then there's something wrong. Toggle cells. What on earth are you talking about with toggle cells? Do I have an example? Of course not. Okay, so toggle cells, it's in that model. Let's do this real fast. I didn't plan on this, but I'm going to show you real fast. Bear with me a minute. And we're right on the, where's my sale? Oh, I'm on the revenues tab. Yeah, I'm right here. So the CEO toggle cell, sounds very official, wow. Right there. What I've done is I've built a revenue tab for you. And here is, again, if you can name the customers, that's much more impressive to the investor, like we talked about. You can actually name some prospects that you've talked to, the product or service they're interested in, your approximate close date, gulp, we think, the approximate amount of the expected sale, and then this extrapolates or automatically produces revenues out here to the right in that tab. But I have a little CEO toggle tab here that if you just build that into your formula right here, does that show up? So what I've done is cell F5, I've got tied to this. So what happens in my year here, and I won't take long, in this year of 2015, I've got 900,000 in sales. Does that show up over there? Let's go back to my revenues tab. What happens if I just say, let me stress test this some. Let me say I only hit 70% of my number. Let's go back to the statements. So now it should be what, $630,000? It is. So what happens to your operations and your profitability and your cash if revenues, you only achieve 70%? You want to look at those kind of things because investors are going to ask that. Okay, you've got 900,000. What the hell do I know what this kid can do? But you've got 900,000. What happens if you only hit 2/3 of your sales? You don't want to be like, whoa, whoa, whoa. What you'd want to do is say, okay, hey, smart-ass investor. I happen to have a model here. You know, I didn't just think of this overnight. Yeah, here's the answer. Got it right away. In fact, I've got it in 10 seconds while we're on the phone. They're like, damn, kid knows his model. By the way, you're never penalized if you have to increase that number. Wouldn't that be nice? Let's hope that would happen. All right, let me go back here. I digress for a minute. So that model, that aspect, I think using toggle cells is helpful because it very quickly allows you to produce what-if scenarios. You don't need to really apply those to expenses because, again, you can change that fairly easily. But the revenues are going to be all over the board. Revenues are the most, again, the hardest to project. A great way to test for reasonableness of what you've produced, and again, that one tab I showed you, I think it's called Statement Summary. So I've got quarterly income statements. I actually got 24 months like I talked about, then 8 quarters, and then I think I have 3 or 4 years in there. So what you might want to do is out to the right on that spreadsheet is go look up information and see what other companies that you can find information on have produced. By the way, all companies were young someday. All companies started. They had to start. If you can find the first 1, 2, or 3 years of some, even a public company's results, compare yourself to what they did. And by the time you've compared yourself to, let's say, 4 to 8 comparables, maybe you've got a 4 to 8 companies' results all combined into the typical P&L for the first year, 2 years, 3 years of a company. Just compare yours to what you've found out there in doing your research. That's not a bad thing to do. And again, that's something that other people might say, where'd you come up with these numbers? Oh, Facebook and YouTube. Why? Is there some problem with that? Are they not good enough comparables? I don't know. Those seem to have done relatively well. So again, be prepared for what investors might ask of you. You can ask your potential investors, investors you've talked with over time that like you, professors, entrepreneurs in the community, out on the internet. You can find a lot of information. I don't have an exact site for you to go to, but there's a lot of info out there. If you go to SEC filings, those are probably going to be their later years, their bigger years, but you may be able to find information on their earlier years, like I said. Sometimes I think I've been able to find up to 10 years, information that's 10 years old. That would go back to the beginning of companies like YouTube and Instagram and companies like that. This is just a kind of a summary tab I think I have in the model, I'm pretty sure I do, that looks at some metrics that I've produced over my 4 years in the model. And again, I might compare those to what I'm able to find out on the internet to see if I pass the sniff test. Because sometimes investors will say, okay, they're going to do this, they're going to do that. You know what? Check. They're probably not even going to look at this all that much. They're just going to say, oh, they've done their due diligence. Good, let's go to the next slide. So a lot of times I've given a model to investors, and it's funny, even though they're financial people, they're like, after about 15 minutes of me going through it, they're like, whoa, time. I believe your model. I'm done. So I've actually appeared bulletproof, or you can, to the point where they're like, whoa, dude knows his financial projections. So let's go on and talk about something else. What you want to do is get them to not negatively focus on your projections. So you've built the model, now what? Like I said, your audience may know or probably will know more about finance than you'll ever know. So what? If you've built the model modularly, have stress tested it, and can give answers reasonably on the fly and have your assumptions documented, you've got a pretty bulletproof presentation, I would suggest. If you're approaching a party for the first time, you don't just want to send them an Excel file with no explanation. You'll probably want to send them that business plan that we've talked about that you probably even wrote before you ever did the financial projections in the first place. It's much more effective if they know something about the business before they look at numbers. If they just get an Excel model that's looking at numbers, it's like, what's the context? What's the background? What's anything? They need to see info before they need to see figures. Okay, let's see here. I think I'm doing a lot of repeating myself, aren't I? So I've said all these things. Again, today it's important to be capital efficient. Actually, the tech market has been heating up for about the past 18 months. So they're actually, except for the China effect, the past couple of months, there actually has been a eerily heating up of the tech market, somewhat like the tech bubble days. I think I'm getting goosebumps actually saying, but that's actually true. So absent the slowdown in China and some of the things that are going on, this ain't a bad time to start a tech company because the market is starting to give a lot of premiums to it. I can't say that we're getting that premium in our acquisition, by the way, but a couple years ago, we might not have been able to sell the company. So I think things have changed for the better. So it's a great time to start a tech company. And I think I'll ask for questions there so far before we get into the cap table. Yes?
I have a couple real quick. This financial modeling is more focused at investors when you're seeking capital or external funding and less for the internal operations, sort of like accounting of your day-to-day operations.
No, I wouldn't say that. In fact, in my model, I actually replace all of the forecasted months with actual. And so in the beginning of the year, I've got 12 months of plan. And then every month I have 1 month of actual, 11 months of plan, 2 months of actual, 10 months of plan. So I actually use it as my ongoing, an annual plan is called the plan usually. Subsequent iterations are called the forecast. It's just kind of vernacular that's used. But yeah, I use it to actually, type in the results. I don't go trying to map all my cells with a link to my QuickBooks and, why do all that? You can type them in 15 minutes. It's not that big of a deal.
Okay.
So, yeah, go ahead.
Yeah, sorry. And then my second question is, in terms of model validation, so comparing to peer companies in their early stages, I think that's awesome. Not something I had really thought about, but if you're in an emerging or new market where, you might be the only company, one of a few people that are at the startup stage, kind of an arms race, so to speak, how do you validate a model? I mean, that's what, we had, for an SBIR application, we had to put a number on a market that doesn't exist. And so we're still struggling with that. And I'm just curious if you have any ideas.
Yeah, well, we were a little bit similar because cybersecurity, even when we started our company in 2012, was still pretty fledgling. And there's been a lot of follow-on, I don't want to say copycat, that's not quite right, but to be honest, I think we'd be an ongoing company that we continue to build if there wasn't so much competition. But in the beginning, we couldn't go to a Gartner report. We couldn't go to a lot of comparables. We kind of had to build what we were able to assess out in the marketplace and then defend it saying, here's what we think it is. From that beginning time, as we moved forward, we were able to get information from Gartner, Forrester, and 451 Group out of Boston, but that only came in after month 24 or so. So I think, for example, in cybersecurity, we were able to find out here's the amount of corporate IT spend per year, here's the amount that's spent on protecting the network, and here's the amount that's spent on hardware, here's the amount that's spent on software, and security, cybersecurity is a fledgling part of it, but here's what we've been able to glean that somehow this is a subset of the software, of the IT spend. So I don't have a crisp answer for you for a brand new market, but that's kind of how we did it. Okay. Any others before we go to the cap table? Yes.
I've only recently started to think about what the market could be for us.
Cool.
And very largely it belongs, like broad domain is knowledge representation companies. So what we're doing though, for any one company that I can find, there might be a piece that we're interested in that they do, but maybe not as well. And so it's not a company that we're comparable to, but certain services or products that they offer. So how do you deal with that?
Yeah. Again, there's going to be some guessing and extrapolating there. I mean, you can almost always find out what companies are spending in a general category, and then you just try to determine your sub-market from there. So I don't know exactly what you're referring to, but
Well, aside from Googling and hoping you find it, isn't there a more strategic way of finding these sorts of documents?
well, there might be investors and VC firms have subscriptions to a number of services that might be helpful, and if you ingratiate yourself to one of them, they could probably try to help you find some information.
I came across a Gartner report, but even then, other people were saying, oh, those are astronomical figures and it's BS, and you're basically winging it. And if everybody knows they're winging it, then what good is it?
Well, like I said, you may be able to find through a VC firm that you can somehow buddy up to that will share some of the data. If you tell them the specific market you're looking for, they may send you information on just that subject. They might not give you access to their whole subscription, but maybe you can find it that way. I know that wasn't a lot of help. Nah, sorry. Yes.
Any recommendations for project financing versus like banks or equity, getting more equity investment?
When you say project, you mean?
We have large working capital requirements. One of our projects, the working capital is under about $4 million.
Oh, wow.
We talked to some banks. The rate they're looking at is about 5% payable completely, on completion of the project.
Wow.
That's what I'm wondering if, but as you mentioned, guarantees, it is the house and everything else
Right.
Associated with it.
Yeah, and you're seeing some of that in the documents as a
Yes.
guarantee.
Yeah, they're very upfront. If you want
Yeah.
to do anything over $1 million, we want your house. And
Ah,
pretty much all your
see,
personal
there you go.
assets.
It's real life. Yeah.
Yeah. But I don't know if any cautionary tales or wisdom. Like a lot of folks say, it's better to go with other people's money, but obviously, the dilution effects are
Yeah.
large.
Yeah, I mean, the best kind of money is grants. Now, that's not near as common. And there's a treasure trove of federal grants that I imagine are quite lengthy to accomplish. There's a company that we actually subleased out, called Accipiter Systems, that has existed for like 12 years on federal grants. Then they converted to federal, agency-based contracts. But that's a pretty long, twisted route. But if you mentioned you've applied for an SBIR loan?
No, so we're looking at some contracts. So it's possible like government financing, but I know that they have their various levels of what
Right.
they'll accept.
Right.
They like to have you secure outside financing, obviously. But
Right.
I didn't know if a lot of I'm bringing it up. A lot of people are like, go with other people's money, not your
Yeah.
own. But I didn't know if you.
Yeah, I mean, depending on your perceived ability to deliver under that contract can then be used as collateral for some type of financing. So I don't know how confident you are that you can deliver. Of course, I don't know anything about the contract. But if you think you can say, hey, with a certain degree of certainty, I think, if we produce what you'll help me to fund, here's the cash flow in the end, and I can service the loan.
Okay.
That kind of ties it all together. Yes? Anyone else? Okay, let's go into the cap table. And I am going to pull up my Excel spreadsheet because I think it's helpful to show you that. Of course, I just realized we lost the slides, huh? But this will be just as good or better. This will actually be better. How big is that? Not very big. Okay, so this is your beginning cap table right here. And let's just focus on these two columns. So you may just be starting the company, so you may actually just have founders and that's it. You have one line. But it might be a few months into it, you might actually have hired or earmarked some people that are going to join your team. I remember the big cheese and the build it guru, I think I called them. So maybe you've hired a couple of extra people. You've actually borrowed a little bit of money or gotten some kind of funding from friends and family. And maybe that's your picture. Or maybe you've actually said, you know what, in founding the company, I need to go ahead and just build out my equity structure, so I'm going to plan on everything up front. I'm actually going to have an employee pool too, and I know the first 2 or 3 employees I'm going to hire that's going to suck up about 100,000 in 100,000 shares, and I've got this much more left. So this is my beginning cap table right here. There's nothing else over here yet. So you can see the employee pool made up, what, 13.3% of the total equity. The typical range is 10 to 15%. I'd say that's kind of in the sweet spot, the average right there. So you're starting out the company in the corporate documents that you've had your lawyer do for free, hopefully low cost, that have 3 million shares to start the company. By the way, there's no magic to the number of shares you have. It's just that it sounds odd for the founders to have 2 shares. The other 3 members of the management team all comprise 0.5%, or I guess what, 5,000 or 0.5 shares. It'd be kind of weird. So really, millions are used just more for presentation. 66.7% is the same no matter what figures you use, whether you have 3 shares outstanding, 300, 3,000, 3 billion, 3 trillion. It's all, what really matters is this, the percent you own, not this number. So these are shares. So that's the beginning of your cap table. You've decided you need some money, as we've talked about. So here is a working funding round picture. And it looks kind of scary, kind of mysterious. It's really not. The 2 cells that are green and blue are the only cells you need to enter here. So let's look at this, and we'll go back to the green cells in a second. The pre-money valuation is always, in this picture, the hardest to determine because a lot of times it's very contested. It's different in everyone's beholding eyes. Founders are trying to pump it up. Investors are trying to push it down, so it's negotiated to say the least. We'll come back to that. The number of outstanding shares before anything happens is known. We just saw it over there. It's 3 million, so it's fixed. The price per share of that first round, I'm calling it the angel round, is fixed. 2 divided by 3 is 0.67. It's fixed. The new money that they're going to put in is some amount of money. I don't know what it is, but you've come to the agreement of $500,000. So that's the only other variable here. The new money shares that buys is $500,000 divided by 0.67, spits out the number of shares they get, which comes over to here, right there. So to your 3 million shares, you've added a new partner, a partner in crime, hopefully a friendly party, 750,000 shares. And that amounts to 20% of your company. So they've just invested an amount to earn or take 20% of your company. The post-money valuation is now 2 million. 2 plus 0.5 equals 2.5, pretty easy. The number of outstanding shares at the end is 3 million plus 750 is 3,750,000. Doesn't that sound a lot easier than you've maybe looked at it before? The cap table is not that hard. It's just math. What is hard is this, and that is deciding what your pre-money valuation should be. And again, all sorts of information you could look at out there that people do and don't like. Any founder thinks they have the prettiest baby in the maternity ward, of course. You've got the most precious company that has ever been created right in your arms. But an investor is like, better than average, but it's still a flyer. Like, okay, great. So you will go out, and here's where you will need inside help, because funding rounds are usually in the beginning very private. That's not out on the internet. It might come out in articles, it might come out with disenchanted employee boards, but not many companies are going to say, hey, we just raised money at this valuation and here's all the math. It's like, companies don't generally do that. So your investor friends would maybe help you out here. However, if they're making the investment, I wouldn't talk to those investment friends. I'd talk to other investment friends that are friendly to you but are not going to be your investors. There may be resources within CMU for some of that information I'm not aware of. I can't imagine CMU in this program wouldn't have some amount of subscription services available to you. I don't know that. But the danger of going too low is what? It's a pretty loaded question. The danger of going too low is over here you own 53.3% of your company after you've raised this 500,000 at 2 million. What did I say, 53.3? So let's change that to 1 million. So I only thought or I was knocked down to $1 million to start the company, so I only retained 44%. That's kind of sucky. So let's and again, who knows what your expectations were? Let's make this 3 million. Oops, 30 million. Woo, I'm really going after it today. Now you've got 57% of the company. That sounds more attractive. But you can see that 50% increase in valuation only got me what, from 53.3 to 57.1. It wasn't that big of a jump. So it's kind of a balancing act of what your valuation is versus how much money they're putting in. You've only got two figures to play with, so again, there's not a whole lot to play with here. But that beginning amount, if you pick that too low, you're going to be more diluted than you need be. If you pick it too high, you may have a grudge-bearing investor, and that's not good either. So they're like, okay, this punk, negotiated me up to twice what I thought it would be. I'm going to bust their balls every time they don't make a number. And I'm going to remember, and I'm just going to keep going like this all the time. So you want to push them to the limit to where you think you left a little bit on the table, and they groused about it, and you kind of went back and forth, but everyone's still smiling, as opposed to, I'm already kind of pissed off just starting with these guys. You don't want that in your investors. So you'll have to feel that through. You'll probably have a legal counsel advising you through this process, because I wouldn't want to tackle those documents by yourself, and they will also be some value-added help there. They also, if they've been around the block a few times, will have clients that have been in a somewhat similar situation to yours that they can give some advice. They may not reveal names, but they can give some advice. Another factor is you could have them pump up this number or not. Maybe you don't want to be diluted more. Maybe you want to take on, let me back up. Your model is going to tell you what you should raise. So that model actually has the other purpose of spitting out the approximate figure that you should go for. Should you go for the exact amount of money that you think you need? No. You should go for more. Should you go for triple? Probably not. Should you go for double? Maybe. Should you go for 1.5? That might sound about right. So I would go for more than you think you need. In fact, go ahead in that revenue tab and put in 0.7, 70% of your revenue attainment. Put in 50%, and then see what happens to your cash, because it's all intertwined. Just go to the statement summary tab and look at the cash line. I think I have it in green. Every time you change an assumption, especially a big one on revenues, your cash goes boom. So raise more than you think you'll need. Plus, you don't want to be doing this again. Let's say you raise funding now, you close by January, February. You don't want to do it again next summer. Plus, it will look like you didn't thoughtfully plan out well enough. That first funding round, I did say 2 years to profitability. That first funding round should at least last 12 to 18 months. It doesn't have to be the only one you ever have. If it is, that's great, by the way. In fact, if you don't have to take any funding, that's great. But you don't want to be going back in 8 or 10 months and saying, you know what, I completely blew it on my projections. They're going to say, well, then we're going to completely blow out the valuation that we had, and then we're going to kind of scrap the cap table and start over. You don't want that either. Yeah.
Now, when you're talking about these funding rounds lasting 12 to 18 months, these are for the large rounds like Series A, Series B, so on and so forth. Probably not in early stage seed as much, right? Because in the earlier phases, just trying to get traction and attract investors at all, it's almost more managing funding sprints, I feel like.
Yeah.
I'm just curious on your insights.
Yeah, like I said, I told this one guy, the longer that you can wait to take on any funding, the better. So the longer you can do it while in college, feed off of your parents' house or funding or whatever, or work your own other job and do this, the longer you can wait, the better. Because you are going to go up on that valuation curve. There are certain measures along the way of the valuation curve. Paper business plan is about as low as you start. 3 to 5 interested prospects is another thing. Working beta is another thing. Beta out in the hands of customers, shipping first product or performing first consulting project. So the longer you can get along that continuum, the better you're going to be. But to your point, you may take a couple of nibbles early because you aren't very sure of exactly how things are going to go. That is less confidence building for an investor. They want to see more of a, not a no-miss plan, because there isn't one, but they'd probably like to see a bit more of a confident beginning to things. But they would also understand if you want to build out and prove out your business model before you take on much funding. You may have to take on, like you say, some amount of funding in the beginning. You may just dip your toe in and take, $25,000, $50,000, $75,000 at first, just to try to cheaply get something done. That almost doesn't even count as much of a round here. That's almost pre all of this, although I'm calling this angel.
What do you think of closing a round? So I'm sure
It's hard.
Investors want as long as possible, right? So if you have a lot of people that are biting, then I guess what's the balance in terms of waiting versus kind of giving them that push to commit?
I don't think investors are going to be, in the tech bubble days, they were quick to close. They wanted to know an answer. They wanted to know pretty fast. And they were very aware, much like the show Silicon Valley. Have people seen that? That is a hilarious, dirty, it's a silly show. It also actually can teach you a lot. I'm not kidding. That's a good show to watch. Silicon Valley. I think there's going to be a second season this fall. I would definitely recommend watching that. What, third? Is it third season already? God, well, I've watched them all. I just forgot. But there's a lot of parallels to real life in that. Now that's out in the valley. It's not in Pittsburgh. But who knows where you guys are going to go? And I'm getting off your question, which was what again? I'm sorry. Oh yeah. So I don't think investors are going to be overly impatient. So and no offense, but the chances are most young companies aren't going to have a lot of suitors. Now you might. That'd be great. I'd love it for each and every one of you. So I think it's not a real, time-sensitive, time crunch kind of thing. Your time crunch is having money to operate with. Maybe you have a lawyer that just won't do things on spec because he or she has done it 17 times for 17 startups and they're just done getting burnt. So they want paid at least maybe 50% of their rate for the first 6 months, then you'll make it up when you close a round. So that might add expediency to the whole process, is people you're working with that need cash in addition to you.
Okay, we have time for one more question.
Okay. Oh, I was thinking 2:30. It's 2 o'clock. Geez, I apologize. Yeah, I got a whole late start to this. Sorry, guys. Yeah, so what else about the cap table or anything else? So see, the cap table is not that hard. That's the hard one. But anything else about the model? I know you probably haven't had a chance to look at it yet. It's pretty straightforwardly built, I think. If you do have questions, I'm happy to have you contact me. My contact info is here. I would like to see show of hands of who is planning on starting a business here? Because I wouldn't know any of your background. Wow. Wow. Oh my gosh. Like 2/3 of the class, 3/4. Awesome stuff. Yeah.
Quick question.
Hmm?
Well, maybe it's too late because I already bought QuickBooks. But do you need that, or would you need
Yeah.
both of these, or is this in lieu of QuickBooks? Or do use QuickBooks and this?
I mean, I've started out a company in Excel. I mean, if you're pretty good at Excel, you can do it that way. But QuickBooks
It
Online,
isn't real complicated,
Yeah.
so I probably could have.
probably could just do that. QuickBooks Online is not expensive. I think, yeah, what's that? Someone said something? It's really not that expensive because you're subscribing to a kind of a watered down version of it. It's not as robust as the downloaded or the installed version. Plus, it can also do payroll. You can invite accountants to look at it to do your tax return. There's some nice tie-ins there.
Yeah. Okay.
Here we go.
You said we can download this, your spreadsheet somewhere, where was that?
Yeah,
So I
Yeah.
emailed it out to whoever registered, so when we checked you in, we got your email address, I will email it out to everybody, and it's also gonna be on the CIE's website, under the Connects workshop materials.
the model and the cap table that we just looked at. But again, any of you want to get a hold of me, I have done some reviewing of financials for people before and generally like to do favors to some degree. I've done a lot of free work in my career, trust me. But feel free. Anything else? Okay, thanks. Appreciate it.